Thank you for joining us and welcome to Business Incorporated. I'm Chimeze Obi Iwago. On the show today, Moody's says top Kenyan banks have stronger cost-to-income ratios than Nigerian banks despite higher retail overheads. IMF forecasts slow GDP growth rate for Botswana this year. Billion-dollar LNG project in southern Mozambique expected in 2020. Let's get the show started with the markets, and trading sessions on Thursday in Africa saw major markets trading in the green territory at intraday. Nigerian stock index rose 0.23% at intraday, recovering from Wednesday's losses. Meanwhile, the JSE index in South Africa dropped 0.47% at intraday, away from temporary shine on Wednesday's session. Egypt's EGX 30 edged up higher at 0.76%, while Nairobi's stock index closed Wednesday's session positive. On the other hand, it was all red in the Middle East at intraday as the numbers traded in negative territory. In Abu Dhabi, the index edged down 0.25%, and Dubai's index also slipped 1.22%. In Qatar, the index was also down 0.23%, extending losses for a third straight session. Saudi Arabian stocks were equally trading lower, down 0.16% at intraday. And in Europe, markets traded lower in the morning as investors monitored friction between the U.S. and China over the Hong Kong protests. Well, let's get more from Ulrich. Hello, Ulrich. Good afternoon.
Hi. Good afternoon.
Well, U.S. President Donald Trump on Wednesday signed into law legislation backing pro-democracy protesters in Hong Kong. Surely not the fastest track to a trade agreement. What are people in the markets where you are seeing?
That's the fear exactly that you're hearing on the trading floor here, and the markets are reflecting that. Most of the European markets are down here in Frankfurt, 1/3%, in London 0.4% down. The CAC 40 in Paris also about 0.2%, in Milan, in fact, almost losing 1%. The euro not quite as affected. It's holding on practically unchanged compared to yesterday this time at just over $1.10. But a trader I talked to today said we have to observe this. It's not a reason to really take the market back, but it's also not a reason to jump into the market with this uncertainty. One hears that the Chinese, the government in Beijing, summoned the U.S. ambassador to China to protest. And of course, one has to see how much this impacts the development, the inching development towards an agreement on phase one of a trade deal.
Now, trade tensions and the slowing world economy are impacting many companies around the world. German automakers are especially vulnerable as they rely most of their sales in foreign markets. Now, BMW and Audi have made announcements this week that are evidence to that. Have job cuts everywhere. How worrisome is the situation?
Yes, when you hear that Audi is cutting 1 in 6 jobs in Germany, that really lets your eyebrows go up. 9,500 jobs are to be cut until the year 2025. Now, the situation is not so dire that they should start firing people immediately and sending them home. Sending them packing basically without a job. They plan to do this, at least at this stage, through natural attrition. That is, when people leave the company, they won't be replaced by new employees. Yet it still is a dramatic situation. They're hit not only by the trade tensions, but they're also hit by Dieselgate, by the move to e-mobility. They have to generate money in some way to pay for all that development cost that goes into making new models. And they're suffering on the sales side because at some point they seem to have lost their touch for new models that are really, really attractive to buyers willing to spend the kind of money that's needed to buy a new Audi. There are all sorts of auto tests that I've seen which are not particularly laudable on that aspect of new Audis. When they drive them around, they talk of people by the wayside saying, oh, is that a new Audi? It looks just like the previous generation model.
All right, let's take a look at Britain. The looming Brexit and the upcoming election hurting business. Some companies in the services industry suffering. What do you folks in Europe think?
Well, I think that it is underscoring the kind of difficulty that the UK has been going through. With all the focus on trade, the Brexit in the markets has come a little bit out of focus, but people really have to look up when they hear that the falling sentiment, the declining volumes, the hurting profits, and the diminished outlook for the business services is making that indicator drop by the most since 2011 for a second quarter in a row. And add to that that services for consumers are also not doing very well. It's a pretty bleak picture indeed, as services in Britain make up about 80% of the economy. And the UK economy, once steaming along before Brexit, it's now at GDP, the third quarter was only at a growth rate of 1% year on year.
All right, Ulrich, thank you for those updates. Enjoy the rest of the day.